Welcome to the Keynesian Ledger, where we break down the forces shaping our economy so you can follow the money without falling asleep. This month, the economy threw out more mixed signals than a frat bro during syllabus week. From global growth to US jobs and inflation, we're covering the key data and decisions that moved markets in July, and what they might mean for the months ahead. Let's dive in. Globally, July 2025 was a mixed bag. The IMF bumped its global growth forecast to 3%, calling it tenuous resilience, which is economists speak for it's not great, but it's not on fire either. Still, that resilience came with baggage. President Trump's sweeping tariffs took full effect, pushing U.S. import taxes to levels not seen since the Smoot-Hawley Act of the 1930s. By August, the effective tariff rate dropped a bit, from 24.4% to 17.3%. But remained far higher than normal, putting pressure on global supply chains and diplomacy. Geopolitical tension, trade frictions, and slowdowns in major economies like China kept global investors cautious, even as some indicators ticked upward. In China's case, sluggish domestic demand and the drag from U.S. tariffs have started to weigh more visibly on growth. In the U.S., the second quarter brought a bounce back. After a 0.5% contraction in Q1, mostly due to a spike in imports in preparation for tariffs, real GDP grew at an annualized rate of 3% in Q2. The Treasury Department called it a full recovery from early year headwinds. But before you start playing the victory parade, the Fed took a more cautious tone. Officials said economic activity moderated in the first half of the year, suggesting that this rebound might not have deep roots. Think of it more like a sugar rush than a structural boom. Strong Q2, yes, but underneath, the momentum still looks fragile. July's job reports raised eyebrows, and not in a good way. The U.S. added just 73,000 jobs, well short of the 105 to 110,000 that economists were expecting. But the real surprise? Downward revisions. May and June's job growth was slashed by a combined 258,000 jobs. May dropped from 144 to just 19,000. June from 147 to just 14,000. And that's not just bookkeeping. Revisions like this often reflect weaker than reported hiring across sectors, from manufacturing to services. It also can shake confidence in the reliability of headline numbers and makes policymakers second guess whether the labor market is as tight as they thought. To put it in perspective, 19,000 jobs is roughly the number of people who fit in Madison Square Garden. That's all we got for the entire country in May. The unemployment rate in July ticked up to 4.2%, its highest since late 2023, marking 7 straight months where perceptions of job availability have declined. Fed Chair Jerome Powell summed it up pretty clearly. The main number you have to look at now is the unemployment rate. And it makes sense. Historically, the Fed has leaned heavily on rising unemployment as a key signal to pivot towards rate cuts. When jobs weaken, policy tends to follow. Inflation picked up again in July. The Consumer Price Index rose 2.7% year over year, up from 2.4% in May. Food prices climbed 3%. Transportation services jumped 3.4%, and energy costs, while still falling, declined less than in previous months. Core inflation, which strips out food and energy, stayed elevated at 2.9%, suggesting price pressures are sticking around beneath the surface. Producer prices told a similar story. PPI inflation slowed to 2.3%, but the effects of new tariffs are starting to seep into goods, particularly in manufacturing and imports. So while the CPI isn't spiraling, it's still too warm for comfort. And as any central banker will tell you, price stability is the one party you don't want to show up late to. Despite the job market jitters and sticky inflation, the American consumer is still spending, though maybe a bit more thoughtfully. The Conference Board's Consumer Confidence Index inched up to 97.2 in July, rebounding from April's low. The theory is that confidence has stabilized, but it's still well below last year's highs. Meanwhile, retail sales rose 0.6% month over month in June and 3.7% compared to a year ago. That puts total US retail sales at $4.2 trillion for the first half of 2025. In other words, consumers are still swiping, even if they're starting to squint a little harder at the price tags. While consumers kept spending, the manufacturing sector hit a wall in July. The S&P Global Manufacturing PMI dipped below 50 for the first time this year, coming in at 49.8. The ISM Manufacturing PMI dropped even further, down to 48. That's 5 straight months in contraction territory. The culprit? Uncertainty. Tariff policies weighed heavily on business sentiment, especially in sectors relying on imports or global supply chains. Manufacturing employment also declined, and new orders slowed, signaling that companies are hesitant to invest or expand without clear policy direction. In short, industry's pausing, not panicking, but clearly waiting for some economic fog to lift. In July, central banks around the world held their ground, but for very different reasons. The Federal Reserve kept its benchmark rate steady for the 5th consecutive meeting, holding it at 4.25 to 4.5%. But the real drama? 2 Fed governors dissented, Michelle Bowman and Christopher Waller, calling for a rate cut. Both are Trump appointees, making their push for easing a notable signal of growing pressure inside the Fed. Chair Jerome Powell stayed cautious, saying the outlook is still too murky to justify a move. With job data softening and inflation holding firm, the Fed's going meeting by meeting, watching every data point like it's a suspicious Venmo charge. Meanwhile, the European Central Bank paused its easing cycle after 8 straight cuts. The deposit rate held at 2%, and ECB President Christine Lagarde said they're in a good place, but added that trade disputes make the path forward anything but predictable. In China, the People's Bank held its loan prime rate steady, 1 year at 3% and 5 year at 3.5%, despite clear signs of softening demand. With tariffs pressuring exports and consumer activity slowing, Beijing's strategy appears to be wait, watch, and hold. Markets kept their cool somehow in July. Despite economic uncertainty, the S&P 500 hit multiple record highs, rising 2.2% for the month. The Nasdaq led the way with strong earnings from Microsoft and Meta, while the Dow and S&P posted solid gains. Tech continues to be the economy's comfort food, dependable, familiar, and apparently recession-resistant. But there were cracks. Volatility crept back in toward the end of the month as earnings came in mixed and investors waited for more clarity from the Fed. Bond markets reflected that uncertainty. The 10-year Treasury yield hovered between 4.25 and 4.5%, a sign that investors remained cautious about both inflation and rate cuts. Commodities were all over the place. Gold soared past $3,000 an ounce for the first time ever as investors hunted for safe havens. Oil found stable footing at around $65 to $70 a barrel. Copper, a tale of two markets. Prices split sharply between US and international buyers thanks to tariffs. The takeaway? Markets aren't panicking, but they're definitely hedging their bets. Earnings season kicked off with a mixed tone. Analysts expected S&P 500 companies to post 4.8% year-over-year earnings growth, potentially the slowest since late 2023. Banks showed surprising strength, beating expectations on both revenue and profit, and tech giants like Microsoft and Meta once again delivered the goods. But it wasn't all good news. Companies tied to consumer discretionary spending or global trade showed weaker results, reflecting rising cost pressures and uncertainty over tariffs. Executives across sectors struck a cautious tone. Capital spending plans were scaled back, especially in manufacturing, where new orders are slowing, and the return on investment looks fuzzier by the day. In short, some firms are thriving, but many are treading water and watching Washington. July 2025 gave us a split-screen economy. On one side, steady consumer spending and strong tech earnings. On the other, rising unemployment, softening business investment, and inflation that just won't quit. Central banks are staying put for now, but pressure is building. If labor trends continue to weaken, or if inflation doesn't cool, something's got to give. A few things to watch out for in August will be updated CPI and PPI reports, of course, the updated jobs report, as well as the Jackson Hole Economic Symposium is taking place next month, so we'll be keeping an eye on that. The Fed is going meeting by meeting, and market bets are shifting by the headline. Will they ease by fall, or are we in for an extended high-rate holding pattern? And globally, the question is the same. Can growth hold up under the weight of tariffs, rates, and geopolitical tension, or are we seeing the early signs of slowdown? Thanks for watching. If you value analysis that sticks to the numbers, hit like, subscribe, and turn on notifications. I'll see you in the next one.